So my name is Rand Pear. I'm a loan officer with Atlantic Home Loans. I am in the Prosperity office on most Mondays. I've met a number of you here, and I look forward to meeting those that I haven't yet met. And you can feel free to reach out to me at any time. Today, we're going to talk about mortgage pre-approval basics and make sure that we have a firm understanding of what a pre-approval is and what role it plays. And we will be discussing it from the perspective both of a selling agent as well as a buyer's agent. I'm going to be going over a grand total of 12 terms in the entire presentation. If you, at the end of this conversation, have a better understanding of how all of these things fit together in regard to pre-approvals, then we will have had a successful time together. All right, so let's start with a few basic definitions. Pre-qualification, pre-approval, qualification, and affordability. So these are all similar sounding in certain respects and are often confused. So thought it would be a good place to start is to understand these definitions in context so that we can use the right terminology and have a proper understanding. By the way, this presentation is oriented toward a newer agent, but I think that regardless of experience level, you will find some benefit here in that it'll confirm what you already know, but it may also disabuse you of some preconceptions that might have developed along the way. I was speaking with my wife about the mission here today, and I told her that I was going to be addressing a group of real estate agents, and she said to me, I said to her, what do you think they would most want to know about? What question would they have? And she said she thought that an important question would be what preconceptions about pre-approvals are, what misconceptions rather are there about pre-approvals. So that's why we're starting with these definitions, because I find that in a lot of conversations, these terms are used interchangeably when they're actually meant to be specific in a certain application. So that is correct. So let's start with pre-qualification and pre-approval. So pre-qualification is best thought of as a conversation between a prospective buyer / borrower and a mortgage lender. It's an opportunity for the lender and the borrower to get acquainted and to get some basic understanding of what the mortgage lender is looking for in terms of information in order to be able to advise the prospective buyer. Pre-qualification's purpose is to give the buyer some sense as to what their borrowing power might be. Pre-approval, however, is an instrument, a tool, a letter, a certificate that is issued by the lender to the borrower / buyer to be attached to an offer. Frequently, pre-qualification and pre-approval are confused. The biggest difference between pre-qualification and pre-approval is documentation. We'll get back to that in another slide. But what's important to understand is the difference is very significant in your conversations with prospective buyers and as a sales agent. I'll get back to that after we go over the next two. Qualification and affordability. Qualification is a measurement of the buyer's borrowing power based on documentation provided that makes up for the pre-approval. In an initial conversation with a buyer, we ask them questions to get familiar with what capabilities they have, but then we rely on the documentation of in order to be able to do a proper qualification of actual borrowing power. And through that, we issue the pre-approval.
Is this where that ratio comes in?
This is where there are a number of ratios, but absolutely, this is where ratios come in. The ratios, which we weren't really going to get into in that much detail, but I'm happy to field questions on the fly. The two main ratios that we would look at is debt to income ratio and loan to value. And if you wish, if we have more time, we can get into this a little further. But sticking with the qualification and affordability, qualification is the actual measurement of one's buying power. Affordability is a measure of a buyer's comfort in terms of monthly spending on housing. So,
budget.
Correct. So, to be specific, either you have a buyer who qualifies for more than they're comfortable spending, or you have a buyer who is comfortable spending more than they're actually going to be able to qualify for. And we can come back into that in our continuing conversation. What's important to know for the moment is that affordability is one's own feeling about how much they're comfortable spending. Why don't we take a second before I go to the next slide and sort of differentiate the conversation from the perspective of the two sides of the real estate agency coin, that is the sales agent and the buyer's agent. When my wife asked me what is the biggest misconception in regard to pre-approvals, I immediately said to her that the answer is the notion that all pre-approvals are the same. Nothing could be further from the truth. Pre-approvals, unfortunately, vary in quality. And if you look at statistics, you'll see that the pre-approvals hold a really shameful pull-through rate in regard to pre-approval and through closing of a loan based on those qualities. And they're meaning the pre-approval is used and is completed in a transaction. Unfortunately, there are many, many occasions where pre-approvals are issued, but for reasons that will be determined down the road, the buyer doesn't qualify under those parameters, and that's where we run into problems. So I'm glad you asked that question, because we were just about to talk about why pre-approvals are important in this conversation and why it's important for you to understand the difference between pre-approvals and their quality. So let's talk for a moment about sales agents. So if you ask any experienced sales agent, they're likely to tell you that when they're advising their seller, that they will tell them that they should not necessarily take the highest offer, but rather should take the best offer. And so if you think about that, what makes up the best offer? If it's not the highest amount offered for the house, then what makes it the best offer? And what the sales agent is talking about is the chances of that buyer being successful in consummating a transaction for the sale of that property. So many sales agents have told me that they've taken offers that are less than the highest offer made because they didn't have a sufficient level of confidence in the offer consummating in a successful transaction.
That's why everyone's calling it, was it highest and best? They want best.
Best
Final.
and final.
Yeah,
Okay.
yeah.
So we've all heard of the unfortunate circumstance of a house coming back on the market. When that happens, there's only two reasons why that could happen. One is either there's an inspection issue where there's some kind of deficiency that wasn't anticipated. And the second is a financing problem. And more often than not, it's the financing problem, not the inspection issue. And frankly, inspection issues are far more easily solved than our financing issues. If there's a crack in the foundation needs to be fixed. It's either going to be fixed or it's not going to be fixed. Either the deal will go through or the house, the listing will be withdrawn. With the financing issue, when you're a sales agent in this marketplace, it's not uncommon to see open houses drawing 20, 30 or more visitors. It's not uncommon to see multiple offers, 5 or more offers on a given house. And so following the weekend of open houses, the sales agent presents the offers to the seller, and there's a discussion about which offer to choose. And when the sales agent is sitting there with the offers, each of those offers has its accompanying pre-approval. Each of those offers varies in terms of the amount offered for purchase, the amount of the down payment, and it will also differ in regard to the pre-approval, which we'll have further conversation about in a minute. So when you're a sales agent, your priority is to not choose the wrong offer, because choosing the wrong offer will lead to a catastrophic situation where you're going to have to, the deal will tank. You'll have an unhappy seller. You're going to have to bring the house back to market. Now it gives the appearance that it's been hanging around, and there is the risk that there would be a perception in the marketplace that there's got to be something going on with this house. Why has this been hanging around for weeks? When in fact, it's simply a matter of wrong offer chosen. So from a sales agent's point of view, choosing the best offer is really critical in order to find success as an agent, but also on behalf of the seller. From a buyer's perspective, the pre-qualification or pre-approval is critical because you are specking your time working for a buyer. And the last thing that you want to do is to be running around with a buyer who is looking for a product that they can't afford or that they don't qualify for. So understanding the capability of your buyer, whether you are a sales agent fielding offers, or you are the buyer's agent representing this buyer in the marketplace, is critical to not wasting people's time, not having deals tank, and not stepping in stuff that you could and want to avoid.
And what's the best way for us to field these pre-approvals? Like if I have a listing and I have 10 pre-approvals from 10 different lenders, what's the best way for me to see which one was weight?
Well, it's I can't say that it's an exact science.
What would you do though, not being in the mortgage industry and I
Well, let me
guess,
tell you what happened last week. We had an agent from this office who is a significant sales agent called and inquired about pre-approval that they had gotten from a prospective buyer and was not sure that she was comfortable with this particular pre-approval. And
was it
one,
from your company or was it a different company?
it was from a different company.
Okay.
And so she sent along a copy of the pre-approval and she asked us what our opinions were of this. And so we were able to give that agent some guidance in regard to the questions that you would want to ask behind receiving such a pre-approval. So to answer your question, the way in which you evaluate the quality of the pre-approvals is by reaching out to the lender and asking the questions on the areas that you have concerns. So for example, this pre-approval that this agent had some concerns for was from a mortgage lender she had never heard of before. It did not specify the program, whether it was conventional, whether it was FHA, whether it was VA, did not specify the context of the review of the documentation of the buyer.
Like how far into the review you are?
Correct. And so if you read a pre-approval and you're not able to differentiate between pre-qualification and pre-approval, then that's what you want to get to the bottom of, is really at the core of the issue.
Should we be asking about ratios or?
Well, you should be asking if ratios have been calculated and do you have any concerns about the qualification of this buyer? You will want to ask, have you been able to verify assets for the down payment? We're going to be getting into what makes up a pre-approval in a minute, so I'll get back to that. But to answer your question, if you're as a sales agent receiving multiple offers, you're going to want to make sure that you're comfortable with the pre-approvals that you receive for each of the offers under consideration. They're going to vary for different reasons, purchase price, down payment amount, but at the end of the day, you need to know that you are confident that if you choose this particular buyer, that they are going to be able to satisfy the conditions, that they qualify, that they're ready to proceed, they're a ready buyer, and that this deal is going to close. But similarly, when you're talking to a new buyer, my recommendation is that early in the initial conversation, you should have a pointed question about the pre-qualification process. Have you spoken to a mortgage lender? When? Who is it? What did you discuss? Were you asked to provide documents? May I reach out to the lender? Because what you want to do is you want to explain to this buyer, many of whom are inexperienced in buying a house, that the challenge here is to get your offer accepted. And that what we want to do is make sure that we are pursuing a house that is something that that buyer is going to be able to secure. And so it's in the best interest of your buyer customer for them to know that there is a difference between a casual pre-qualification and a thorough pre-approval. By the way, if anyone has any questions on Zoom, just let me know and we'll take them.
Question,
Sure.
maybe covering it, I'm not sure. My question is always, what's the difference between a lender like you guys and a bank?
Ah, that's a great question. So let's see if I was prepared to answer that. Oh,
It's on there.
thank you. Thank you for the lead-in. All right. So, we started the conversation with the misconception that all pre-approvals are the same. And so now we're going to jump into exactly what you led us into here, which is how do they differ and why do they differ? And it starts with the sources of mortgages. There are basically 4 silos of mortgage lending, and each of them has their own characteristics and gives you some sense as to the conversation that has been had with the prospective buyer. So the 4 categories you see on the screen are institutional banks, regional banks, online providers, and private mortgage lenders. So let's define them and compare and contrast. So institutional banks is basically, JP Morgan, Wells, and Bank of America. These are international banks with a broad portfolio of financial services, and they are primarily interested in wealth management. So if your buyer is one who has a lot of assets, then they are of interest to the Wells, JPs, and B of A of this world. Not for the mortgage, but rather for their investment money. So in the pursuit of having this customer, they offer a breadth of services, of which mortgages is one. So the first differentiating factor between an institutional bank and the other mortgage lenders is that institutional banks, this is one of an array of resources that they're offering their customer, that it's not their primary focus, it's not their only focus, and they do it to supplement the range of offerings that they have for the customer. And they are particularly interested in servicing high net worth individuals so that they can retain their investment money in-house. For that privilege, these investment banks are able to trade on their own account, which is known as portfolio lending. They keep these loans on their own books, and they're able, because they keep these loans, they are able to undercut the marketplace by 1/4 of a basis point. And in doing so, they can cherry pick the very most well-qualified customers and offer them pre-approvals and offer them an interest rate that none of the other lenders can match. The vast majority of the loans in today's marketplace are known as conventional conforming loans through Fannie Mae and Freddie Mac. The reason for that is that those loans are not only the cheapest form of financing, but they have the least risk based on the government-backed financing from these institutions. So the vast majority of loans out there are conventional conforming loans. When we talk about institutional banks, we're talking about portfolio lending, meaning that they're not reselling this into the secondary market, which becomes part of a collateralized mortgage-backed security and is sold in the secondary market. They are keeping these loans on their own books. They're only interested in taking on loans from extremely creditworthy customers who have investment money that they keep in-house. And they do this as a service complementary to the range of services that they offer. So that's their game. Now, if you ask a sales agent about receipt of a pre-approval from a Wells or a B of A or a JP Morgan, well, perhaps you should ask yourself, but my experience has been that sales agents are not jumping up and down for joy in receiving such a pre-approval, because the downside, the reputation of the institutional banks is that it is an impersonal process. It's an 800 number. You're known by your social security number. It's customer service. It's the typical institutional experience.
Not personally.
However, for the sales agent, it goes further than that. It's the question of, will this loan close on time? Now, on the other hand, the chances that the pre-approval is credible from a source of Wells or a B of A or a JP Morgan is higher than some of the other mortgage lenders. However, getting to the finish line is often less pleasant than some of these other vehicles. Which leads down to the second category, regional banks. Regional banks, we have a few people joining. That's okay, welcome. We have some people on Zoom as well, so we'll continue. So we were speaking about the sources of mortgages in the context of understanding what a pre-approval coming from these various categories means in the marketplace, and what it means to a sales agent, and what it means to you as a buyer's agent. So we just got done talking about the big banks. Now we'll talk about the second tier, what I call the regional banks. By the way, these are not sharp delineations, but these are broad categories, of which there are 4 broad categories. So the second being the regional banks. The regional banks are the banks that the investor banks and the other banks that are sort of in that second tier of lending, where they offer mortgage services. They are banks. They have retail bank locations. They're offering a range of services, a range of product lines, and mortgages again is one. So it's not their only business. It's part of an array of services they offer. Typically, regional banks are looking for conventional conforming lending so that they can resell these loans into the secondary market. They offer a limited number of programs, and they have what I refer to as a single rate sheet, which means if you walk into a bank and you ask them, what do they have to offer for a 30-year fixed loan? They look on the page and they see what today's rate is, and they say 3%. Okay. So a regional bank has one offering basically per category. Maybe they have different terms, 30-year, 15-year. Maybe they have some other options, but typically you're talking about a conforming loan, or what's known as a high balance loan, which is a mid-level loan, or a jumbo loan. Some of these banks have some and not others. But typically they have one set of rates and it comes off of a rate sheet. So
Does it not matter with credit?
typically they don't differentiate on things like credit, loan to value, debt to income. Yeah. So because they're working off a single rate card. Okay. Again, the important thing to understand is that when you're dealing with a pre-approval from such a bank, it is part of the array of services that they offer, but it's not their singular focus. Okay. Frequently, both with institutional banks and regional banks, as an example, we've heard of use of out-of-state appraisers, out-of-state underwriters. So it is, it's definitely an arm's length type of a process. And it doesn't mean that it's any better or worse necessarily, but to know from where it comes is to understand better what the quality of the pre-approval that you're holding is. The next category of mortgage lenders is the online providers. You know the names, they spend a lot of money on advertising. The Quickens, Rockets, Loan Depots, and all the upcoming vendors of such services. Now, what I find very interesting about this category of lenders is that they spend an inordinate amount of money on advertising. But if you think about it, none of them that I have ever seen has ever once said that they have the lowest rates, or even that they have competitive rates. They are pitching technology to a younger audience who's comfortable putting their social security out into the cyber and is not concerned about privacy or confidentiality, but rather embraces technology without concern and is not interested in having the support of an individual. They don't even know who they're sending their information to. They don't know where it's going. They don't know the levels of protection. And so when, again, we've been speaking about both on the sales side and on the buy side. So on the selling side, when an agent receives multiple offers, and one comes from an institutional bank, another comes from a regional bank, a third comes from an online provider, and a fourth, a private mortgage lending group. These are 4 different pre-approvals from the get-go, and you need to look at them through an appropriate lens in each instance in order to make a determination. Now, let's look at the practicality. Let's say you get a pre-approval from Bank of America, and you have a question on the capability of the buyer. Bank of America, institutional. Okay. So, or a Wells or a JP Morgan. All right. What are you gonna do? Yeah. Well, yeah. So what are you gonna call Wells Fargo and say, hi, can I speak to the person who spoke to Mr. and Mrs. Jones about their mortgage pre-approval because I had a question? I don't see that being productive. If you have a regional bank, then likely they're dealing with an individual. They have that person's business card. That person has a telephone number. That person has had contact with the buyer individually. It's just a whole different ballgame from the get-go. Okay, sure.
So I have a buyer right now that is pre-approved from Wells Fargo, and like they're very good friends with like the vice president of like the whatever in
Right.
Wells Fargo, somebody higher up. So I didn't know that it's such like a difference. People don't like looking at pre-approvals from Wells Fargo. So is it like worth it when submitting an offer, like putting the guy's contact info?
At Wells?
Yeah, like so.
Oh,
they know
yeah, it
that
would
we're
be
doing-
definitely, without a doubt. That,
Okay.
in my humble opinion, that would help considerably.
Okay.
And by the way, I need to be respectful of what is for me, my competitors in this realm. So I hope I didn't say that sales agents don't like Wells Fargo's
No,
pre-approvals. No, it's okay. What I did say is that I have heard sales agents having had experiences with these bigger banks that are more arm's length, impersonal, and challenges towards closing on time. So if your seller's priority is, I have to close this deal by a certain date, and you have pre-approvals from a variety of sources, one of the questions you would have for the institutional lender is, how do I know this deal is going to get done in this time frame? Okay. Similarly, if you were to receive a pre-approval, again, you're a sales agent, you receive multiple offers. One of the offers comes with a pre-approval from an online vendor. Now you got to ask yourself, well, what is the quality of the pre-approval if the process is that the individual gives their most precious financial information over into the computer and then they receive a piece of paper back? There's no interchange of ideas or asking of questions, or there may or may not be a function for document collection. You don't know the extent to which there's been an engagement in the marketplace. I will tell you that I have heard that of these 4 sources of pre-approvals, the online ones are really the most dicey. Okay.
I, in a sense, not discouraged some buyers. It's before they got their pre-approval, I would say, I have some lenders that I can recommend to you, and I pretty much say, we don't recommend a bank, but I never know how to tell them why not. But I do lean towards the side of saying that here are some mortgage lenders that we work with that will help make the process go smoother because we have relationship with them.
Mhm.
I kind of lean it towards the relationship
Positive
part,
side, right?
right? So let's say somebody comes to me that has a bank pre-approval.
Mhm.
What could I say to maybe, I don't know.
Well, if it came from either a Wells or a Bank of America or a JP Morgan, you might ask, how were they lucky enough to engage you in this and provide this pre-approval? What is the nature of your relationship with this bank? Did you just walk in the door? Or do you have accounts with them? Did you speak with an individual who interviewed you, and were you asked to provide documentation? And so now you can lead into the conversation, and simply by asking those questions, you get the buyer to understand what is the theme of today's meeting, which is not all pre-approvals are the same. And when you're advising a buyer in this marketplace, I think the biggest challenge is keeping them in the game, given the competitiveness of the marketplace. The chances that you're going to go out, find a property, put in an offer, and have your offer accepted on the first go around in this marketplace is not great. There's just tons of buyers out there and not a lot of product, and there's multiple offers. And the likelihood is that your buyer is going to have to put in multiple offers. And once they get rebuffed once or twice or 3 times, their reaction is going to be either to redouble their efforts and their focus and determination, or lose interest in the process and fade away. What we want them to understand is that we want them to have success. We don't want them to, we want to maximize their chances of having their offer accepted. And we want to make sure that we minimize the chances of some error in calculation along the way. So it's in the buyer's best interests to have a quality pre-qualification and pre-approval in order to enhance their chances of finding success in the marketplace. So when you ask about the level of conversation and scrutiny and due diligence in the process of the pre-approval, you unearth the notion of the quality of what they have received back. If you don't have good information in, you're not going to have good information. You're not going to have good output. So you can couch, and I'm not, I don't do what you do, but I would think that one way of going about it is to set the expectations about what it is to engage the marketplace and the role of the pre-approval and the importance of the pre-approval in order to find success. I am hearing with an increasing number of frequency that buyers are coming to real estate agents with a pre-approval in hand. Now, if that happens, my suggestion would be to inquire about that pre-approval, where it came from, drill down, figure out what's going on. If they have an online approval that has not been sufficiently vetted in your opinion, then you can tell your buyer that you have concerns for their welfare in the marketplace amidst multiple offers.
How many times can they have their credit ran before they get another hit on their, yeah. Like, cause like if they say, hey, I got my pre-approval last week,
Right.
you know, like today's August 15th. I got my pre-approval on August 1st. They ran my credit on August 1st. Are they gonna run my credit again?
The answer is yes. We would need to, if they, and the first question is, did they even run your credit?
Yeah, but
Okay.
if they did, then
So, okay, so just so that you know, as a general rule, so don't hold me to this, but my understanding is that multiple credit report inquiries within a relatively short period of time, and that's the part that I'm not sure of, is deemed to be a single inquiry to the borrower's credit. So if the inquiry was a recent inquiry by a single mortgage lender, then a subsequent inquiry by a second mortgage lender in a short period of time will not have the adverse effect, double the adverse effect of the inquiry. Okay. So, but I think you're getting what I'm trying to communicate here, which is protect your interests as a buyer's agent, so as to make sure that you're running around with a qualified, ready buyer, but also use this opportunity to educate your buyer as to what's going on in the marketplace and why it's so important that they get their ducks in line, that they have their documentation ready, that they're a ready buyer in order so that they can find success in the marketplace. And then you'll be able to gauge whether or not the level of cooperation and focus of your buyer, and that will help you determine how you want to handle the situation. So if somebody says, I got my online approval and let's go look at houses, and you ask a question about it and they're not making the right noises, trust your instinct. Okay. One of the things with new agents in particular, that they're more susceptible than experienced agents, is they'll run with a buyer. If you don't have anybody to talk to, and now somebody says, oh, I want to buy a $500,000 house, the last thing you want to do is run the risk of alienating your customer by asking the wrong question, a little too much forcefulness. But if you don't get into this realm, you're specking your time with an unknown outcome.
Definitely the buyer consultation is really important too.
Yeah.
Taking time to have a half an hour conversation, hour conversation with them, you know, preferably in person, definitely will go a long way.
But don't waste my time. Yeah, take the whole.
No, I mean, if they don't want to meet with you for half an hour or an hour to have a buyer consultation, then, you know, that could be a sign as well.
Rand,
Yes.
I have a question. I have a buyer now I'm working with, and he has a VA loan. What's your experience with VA loans?
VA.
Pre-approval. So he's
Okay.
pre-approved through a VA.
Okay. So you're confusing two things here. Thank you for your question. So VA is a program. It's not a lender. Various lenders do VA loans.
Okay.
Various lenders do conventional conforming loans. Various lenders do FHA loans. So when you ask the question, you're asking about the quality of the VA pre-approval. And that goes back to the lender that is offering the pre-approval, not the program specifically. Each program has its own requirements.
Okay. Because the reason I'm asking is because so I'm obviously representing the buyer. The listing agent asked me today. He was like, "Hey, I never worked with a VA loan. How long is it going to take for us to get it to close?" And I told him I'm new, so I was like, "Well, I know they do have their own appraisal that goes out from what he told me and what the VA loan what they sent me.
Mhm.
So they said they were more strict on their process." From
That
what I
is,
can read.
the program has more stringent requirements, as does an FHA program, as do each of these programs have their own particulars. In fact, within conventional and conforming loans, there's different standards for Fannie Mae and for Freddie Mac, which a lot of people don't know because they're both conventional conforming loans. But every program has its requirements. And what we're talking about now is the lender and what they do with that program. What is that lender going to need, and how does the VA program affect the requirements and the chances of closing on a timely basis? So my recommendation would be for you to reach out to the lender and inquire about their experience and what goes into the VA loan and what it's going to take and what their assessment of this particular buyer's qualifications are relative to the loan. What have they documented the military history of the prospective buyer? This goes to the quality of the qualification of the lender toward the buyer's acceptance within that given program. So just because somebody has had military experience does not mean that they automatically qualify for a VA loan. So it goes back to the lender. The questions that you're asking are to the lender, and do follow your instincts. If you're not getting a straight answer, if it doesn't sound right, trust your instincts.
Okay, thanks.
You're welcome. All right, the fourth category of mortgage sources is private mortgage lenders. Within private mortgage lenders, you have what are known as brokers and bankers. Why don't we start there before I forget? So a mortgage broker is basically an individual or a company that fronts the sale of the loan to an institution, and they get paid as a broker. So they bring the broker, they match them up with the institution, and they're not involved in the process between what goes on from the finish to the end. There are certain applications where brokers and bankers have different reasons why they might have more to offer. But a banker, of which Atlantic Home Loans is a banker, means that we do our own in-house underwriting, that we process the entire loan from A to Z, and that we at Atlantic Home Loans make it clear to the buyer that it's our intention to sell their loan in the secondary market as a convention, typically as a conventional conforming loan, because those are going to be the cheapest form of financing for the buyer with the lowest transaction costs. Now, the advantage that private mortgage lenders have is that we have multiple investors and multiple programs. So whereas a regional bank, for example, has a rate card and they have chocolate, vanilla, and strawberry, private mortgage lenders have 32 flavors. And within each of these programs, we get rates from investor partners on a daily basis. So what I'm fond of saying is that I am highly confident that our rates are extremely competitive because we are basically conducting an auction for your business every single day. We gather rates from 20 or 30 different investors for every program every single day. So for a 30-year conventional conforming loan with a loan to value of 80% or less, here's the lenders. And they're lined up in order of lowest price to highest price. And so every single day, we're able to conduct an auction for all of our programs, and we determine which program is best suited for this particular customer. We don't just have 3 flavors. We have a wider breadth of offerings in terms of programs, typically. And we also have multiple investors for each of these programs. So as a private mortgage lender bank, we are underwriting these loans in-house. We're closing the loans in-house. We are funding the loan. We're at the closing table. And then shortly after the close, the house is sold, the loan is sold to a mortgage loan servicer.
You got the hard money.
Hard money is, we do. That is a separate category of what we haven't referred to at all in our conversation, which is what is known as non-conventional lending or non-conforming lending. Yes, we do non-conforming lending as well. But this conversation is really focused on the conforming conventional customer, which makes up the vast majority of the marketplace. So again, in summary, if you're a particularly well-to-do individual, then an institutional bank where you have your money might be the source of your lowest cost of capital. Regional banks have fewer offerings, but it's a more personal experience. Regional banks are particularly good at construction loans. Online providers tell you something about your buyer straight away.
See, wait.
Well, you know, that's for you. I would say this. With the advent of technology, we have seen the influence of Zillow in influencing customer behavior. And I work with a lot of sales agents and with their open houses, particularly their first open houses. And we have seen that approximately half of all of the visitors of these open houses are unattached, first-time home buyers frequently, who have neither spoken to a lender nor an agent. They think that they can go online and shop as if they're shopping for clothing online and pick their size and their color, and that's how they're going to buy a house. And they show up in an open house as if they're going to a bakery, only to discover that there's a line out the door to get into the house and that they have no idea what they're doing. And they haven't had any substantive contact with anyone within the business. And therein lies tremendous opportunity for both the lenders, but also for the sales agent. And you don't even have to be the sales agent if you're lucky enough to host one of these open houses on behalf of the sales agent. Then, you're collecting information, you're meeting people, you do proper follow-up, and you're going to determine that there is a certain portion of the audience that there is an opportunity for you to work with and to help them find success in the marketplace. So private mortgage lenders are typically, certainly in the case of Atlantic Home Loans, much more personal experience. I like to make sure that the buyer knows that we are a resource, that we're available on weekends, nights, and holidays, that we have a broader breadth of programs, a larger number of investors for each of these programs, and so chances are more competitive rate schedule, and that we will walk them through the entire process from start to finish, starting with having them understand what a pre-qualification is, what a pre-approval is, what qualification is, and what affordability is. And then we hand them back to the agent as a more educated, refined buyer who has a certain target where they know what they can afford. They now are a better candidate instead of you just as a buyer's agent just sending them listings randomly and seeing what they're attracted to. Now you are targeting the listings toward the buyer values and qualification, and you create a much more efficient and successful process through that. All right, let's forge ahead. So now that we know the sources, let's talk about what goes into a proper mortgage pre-approval. I guess I gave it away here because I was going to ask and see how smart you all were, but I didn't put anybody on the spot here. So I guess it's better to do it that way. So when you're talking about a mortgage pre-approval, there's 4 categories of information that we need to be able to gather information on. Now, when we talk about income, assets, employment, and credit, we can speak about it in the context of a pre-qualification, which is these are the categories of information that I would have in initial primary conversation with a buyer about their determining their buying power. So tell me, where do you work? How long have you been there? What do you make? How are you paid? Are you salaried? Are you hourly? Are you weekly? Do you have a contract?
Contract and salary is the same thing.
It depends on the tenure of employment, is the general answer to the question. So yes, it's in the same category, but somebody who has a contract of employment that specifies a start date, a title, and a salary, I can qualify based on one pay stub.
So I guess we use an example of like a college graduate who just gets out. They go into either self-employed, contract, or salary. Who can buy a house fastest?
Well, who can be qualified based on their income fastest would be the one that has the contract.
The contract. Okay.
That's a W-2 employee. The same job without a contract, we need pay history, typically 6 months. If you have a contract and it designates a starting date and a position and a salary, then we can use the first pay stub. Huge difference.
But us, we have to wait 2 years. I learned that the hard way.
Self-employed is much more challenging, particularly in a post-COVID environment.
We might have to have a sizable down payment.
That is going to influence the pricing of the loan, and it will influence the ratios, the loan to value specifically. But it will also affect the debt to income because you're borrowing less money, so therefore you need less income. So indirectly, it affects that ratio as well. And then we have credit. Credit is a credit report. We've spoken about doing a hard pull. So you have buyers that are reluctant to have their credit pulled. Just as a general reluctancy, not for any particular reason necessarily, although sometimes they do express reasons specifically. There are I've seen pre-approvals issued without there having been a proper level of due diligence in regard to an investigation of the credit capabilities of the borrower. Anything from accepting income without pay stubs, accepting statements in regard to how much assets they have, less frequently employment, because that's pretty easily verified, and in regard to credit issues. There are a lot of times that buyers are either not aware or they don't want to tell you that there have been some issues. So if you go online, you can get yourself a pre-approval pretty quickly, but let the buyer beware. So, as I said, when we started, we wanted to define a short period of time. We've already been on for over an hour. I thank you for your patience, all of you. So we're not going to be able to get into how I evaluate income, assets, employment, and credit. What's important for you to know is that that's my job, that's what we do, that we're going to drill down, that we're going to get full documentation, and that we will return to you a pre-qualification and a pre-approval that you can rely on. I will say one other thing. At KW, Atlantic Home Loans enjoys a preferred lender relationship. We pay for that, but we also earn it because your reputation is, you trade on your reputation. So I can assure you that any pre-qualification coming out of Atlantic Home Loans is going to be reliable, bankable, pre-approval. We have very strict standards. We will not accept a representation when documentation is required. And we have to uphold our relationship in the marketplace, but also within this office. So you can have an extremely high level of confidence in regard to pre-approvals issued out of Atlantic Home Loans. I promise you that.
Are you doing like a follow-up class, like to get more in depth into the thing, anything
I-
else? Or is it like
Whatever,
part
it-
two?
whatever you'd like me to do, I'm happy to do it. So this was our first get together. I'd appreciate if you could give me some feedback in regard to whether this was clear, informative, helpful, what.
Very much. You're very good at making it clear and structured and flowing really nice. It
Excellent,
allows me to follow it
terrific.
easily.
So I thank you very much. That was very kind of you, Maria.
So
Thank
it's
you.
true.
So, you know, I'm as close as a phone call or an email. I am more than willing to help you with your individual circumstances, with an individual buyer, with if you're trying to evaluate a pre-qualification to help you determine what questions you're going to want to ask, to give you confidence that you're working with a qualified, ready buyer, and to anything that I can do to help you increase your chances of being successful in a highly competitive environment. So I'll look for a little feedback, and I would look forward to getting together again soon.